They swung at the market at 4 a.m. London time. One clean punch, straight at the $70 handle, trying to slam silver through it and turn your screen into a panic button. Price wicked down to $70. 67, and the message was loud. It's over, get out. But here's what actually happened. The drop didn't break the market, it exposed the trap. We're going to walk through what they tried, what failed, and what the system accidentally flashed in public while everyone was staring at the candle, because that red bar wasn't price discovery. It was a controlled demolition attempt. They didn't pick $70 because of fundamentals. They picked it because of psychology. That number is a tripwire. It's where stop-loss clusters sit like dry leaves. It's where small accounts get hit with margin stress. It's where fear feels reasonable, so it feels safe to sell. So they targeted the nervous system, not the chart. And let's talk about why they chose that hour. 4 a.m. London is a liquidity hallway. It's not the busiest street. It's the moment where spreads can widen and a smaller order can shove the print further than it should. That's why the hits arrive in the dark, not because they're brave. In thin liquidity, the order book is like a shallow pond. Throw a rock and it looks like an explosion. The splash scares everyone standing nearby, even if the water itself didn't disappear. They rely on that optical illusion. They want one ugly wick, so the algorithms read breakdown, the stops fire, and the momentum crowd joins the selling for them. And this is where the trap becomes mechanical. Stops aren't opinions. Stops are autopilots. When you place a stop at 69.95, you've pre-signed a contract with fear. The moment price sniffs the level, the system sells for you, whether you're awake or not. They know that. So they don't need millions of people to choose to sell. They just need to tap the domino. But the domino line didn't fall. It shuddered. That's why the rebound matters more than the drop. A fast rebound is the market saying, your rock hit the pond, and the pond is still here. It's demand stepping forward, not tweeting, not talking, buying. So ask yourself another uncomfortable question. Who buys aggressively into a pre-dawn flush? Not tourists, not day traders. It's usually someone with a deadline, someone whose loss is not a red candle but a missed shipment, someone who can't show their client an excuse. And those buyers have a tell. They don't chase tops. They wait for engineered weakness, then they hit the bid with purpose. That's why these traps are dangerous for weak hands and useful for strong hands. The same candle that scares one group becomes a shopping signal for the other. Now, there's another layer most people miss. When the market fails to break after a smash, it can force the short side to defend higher and higher levels, like backing up while still swinging. That's when you see sudden rule changes show up. More margin, less leverage, new position limits, temporary settlement tweaks. It's not conspiracy, it's incentives. If the plumbing is tight, the system tries to reduce pressure by shrinking participation. From the Asian session, hovering in the low 71s, they dumped paper hard enough to shove the price into the 70s and wait for the cascade. You know the playbook? Big red candle, retail pukes, forced liquidations, then a deeper slide so the hitter can buy back cheaper. That script has worked for years because most people don't trade a market. They trade their own adrenaline. But this time the market didn't stumble. It bit down. Look at what happened after the low. No slow recovery, no polite bounce. It snapped upward like a spring they pushed too far. That kind of rebound isn't hope. That kind of rebound is a hungry bid. So we need to ask the question they don't want us asking. If that dump was real selling, why did it get absorbed instantly? If the rally was dead, why did buyers show up like they'd been waiting all night? If this was organic fear, why did it reverse with violence? Now watch this detail, because it matters. The size and timing of the sell wave was the giveaway. Huge paper volume, compressed into a narrow window, dumped with zero finesse. That's not a crowd changing its mind together. That's a coordinated hit. Somebody wanted a print below $70. Somebody wanted screenshots. And the moment those screenshots existed, the other side said, perfect, and started scooping. Not with vibes, with scale. Not with emotion, with scheduling. The buyers that matter don't buy because the candle looks pretty. They buy because they have a procurement calendar and a delivery obligation. They buy because the spreadsheet says the metal must show up, not because social media feels bullish. By the time most people woke up, doom scrolled the chart and felt that gut sink at $70. 67, the price was already being yanked back toward the level they needed you to believe was broken. That's why we call it what it is, a bear trap. And here's the uncomfortable truth we need to say out loud. If you sold into that flush, you didn't sell because you analyzed. You sold because your nervous system got hijacked. That's not an insult. It's the business model. These moves aren't designed to beat experts. They're designed to overwhelm normal people. They want shaking hands. They want misclicks. They want you to hand them metal at a discount while they posture as if they're in control. But the chart is the theater. The real story is what flickered behind the curtain while the crowd stared at the stage. Because right around that flush, something else glitched. Not a meme, not a rumor. Infrastructure. During that critical window, a major public-facing portal tied to the Western physical bullion system went dark. Pages failed to load. Errors popped up. People in our community noticed it in real time while the candle was still forming and started posting screenshots. That matters. First, it proves we're not watching alone. We're watching together, and that changes the game. Second, it tells us the system doesn't like being stared at when it's under stress. You'll hear the easy dismissal. Traffic spike. People refresh too much. Server hiccup. No, institutional infrastructure that clears billions doesn't simply fold because a few thousand people hit reload. These systems are built for stress. They are supposed to be boring. So we have to entertain a darker possibility. What if the portal didn't go down because of traffic, but because the numbers behind it didn't reconcile cleanly? What if the ledger tried to update and the math looked ugly? Because in a physical market, there's one number you can't show the public, a negative. You can't have negative bars. You can't have inventory that exists 3 times on paper, but only once in a vault. You can't stack claims on the same metal like you're photocopying a car title. And if the system leans on leases, swaps, rehypothecation, whatever polite word makes it sound normal, stress is what forces the check. Stress is what asks the only question that matters. Show me the metal. Now let's be careful with our certainty ladder. Fact. A sharp paper-driven flush hit at 4:08 a.m. London and printed $70. 67. Fact. The price rebounded fast. Fact. A key public-facing portal reportedly went offline during the stress window. Rid. That timing looks like a transparency flicker right when transparency matters. Possible risk. Glitches like this can foreshadow bigger access issues later. If everything was fine, why would visibility blink at the exact moment of maximum tension? Why would the blinds come down when the room gets loud? If you were sitting on numbers that could trigger a stampede, what would you do? You'd buy time. You'd shut the window. No, you'd call it technical maintenance while you fix the display. And if that sounds dramatic, good. Markets aren't polite. They are violent when trust breaks. They are violent when a shortage stops being a rumor and becomes a line item in somebody's quarterly report. While London was blinking, another signal came in from the physical lane. Small retail shipments out of Australia started getting blocked at export. Let that land. Not a refinery-to-refinery bulk transfer, not a container ship reroute. Small retail packages, coins, bars, orders regular people make, held up. In a normal world, you call it a delay. In a tightening world, you treat it like a policy trigger. Customs doesn't personally review every parcel like an old post office clerk. Customs runs software. Software follows rules. So if small shipments are suddenly getting flagged, we have to consider someone toggled a switch. That's what resource control looks like when it starts quietly. No speeches, no emergency press conferences, just friction, then throttling, then a stop. And sure, one country slowing exports doesn't end the market. Metal can reroute if the pipes are wide open. But what happens when multiple choke points tighten at the same time? Australia produces, Switzerland refines, London warehouses and clears. When those lanes get sticky, the supply chain stops behaving like a river and starts behaving like a dam. And dams don't leak politely, they hold, and then they fail. The big mistake most people make is they watch silver like it's a stock. They think it's a mood ring. They think sentiment is the driver. But silver right now isn't a story asset. It's a plumbing asset. It's flow, it's delivery, it's can you actually get it where it needs to go on time? When the plumbing gets tight, the paper chart becomes noise. Availability becomes the headline. Now, right here, the same argument always crawls out of the comments. Okay, but price can't go that high. At $200, industry stops. Solar can't afford it. Manufacturers will switch materials. Parts of that sound logical until contract reality kicks the door in. Let's do it the smart way. Define the metric in one line. Input cost is the cost of a critical material inside a finished product. Why it matters. If it spikes, it crushes margins. Apply it here. Solar panels use silver paste as a conductor, and modern performance depends on that layer. Fact. You can't mass produce today's high-efficiency panels at scale without a conductive paste that performs like silver. Read. As silver gets more expensive, panel margins get squeezed. That's real. But here's the twist. Industry doesn't buy based on what it wants to pay. Industry buys based on what it must pay to avoid default. Default is the word that turns pricing into survival. Think about how projects actually work. Manufacturers sign delivery schedules. Developers line up financing. Utilities commit timelines. Governments write tenders. Miss the date, and you don't just lose revenue. You trigger penalties. You trigger lawsuits. You trigger covenants. You trigger a reputation crater that kills next year's orders. So the decision stops being, is silver expensive? And becomes, which choice kills us slower? Option 1, refuse to buy, miss delivery, eat penalties, risk bankruptcy. Option 2, pay the market, deliver at a loss, and live long enough to renegotiate later. Most executives choose oxygen. They pay the ransom. That's what inelastic demand looks like in the real world. It doesn't disappear smoothly. It holds until something snaps. And before it snaps, it bids insane prices to keep the machine running. So when people say price can't go there, we answer, price can go wherever it must go when supply is tight and obligations are non-negotiable. Now put the signals back on the table. A pre-dawn paper flush failed to trigger a cascade. A major public-facing portal blinked right at the stress window. Physical shipments reportedly hit friction at export. 3 signals stacked. When signals stack, we don't scream. We measure. If they couldn't hold $70 down with a full force hit, what does that say about the real bid underneath? If inventories were comfortable, why would transparency flicker under pressure? If metal was abundant, why would borders start getting sticky on tiny shipments? And here's the part that should make your skin crawl. The next phase might not be about price at all. It might be about access, because shortages don't always announce themselves with a $200 print. Often, you don't wake up to a big number. You wake up to out of stock. You wake up to delivery delayed. You wake up to allocation priority. You wake up to verification required. By the time the chart confirms the move, availability is already gone. That's the sequence. Friction first, scarcity second, price last. Now, we're not here to tell you what to do with your money. This is educational. We manage risk. But we are here to ask the obvious questions together. If a public portal can go dark during stress, what exactly are you trusting when you hold a claim instead of metal? If exports can get throttled quietly, what happens when the squeeze turns from tight to critical? And here's the open loop nobody wants to say out loud. If that was their best shot, what's their next move? Because failed traps have consequences. When a trap fails, the hunter gets exposed. And exposed hunters get desperate. So what do desperate players do? They pull levers that don't require metal. They jack margin requirements. They widen spreads. They flood headlines. They blame speculators. They try to turn a plumbing problem into a morality play. But those levers don't create ounces. They don't refill vaults. They don't unblock packages. They don't fix a ledger that's stressed. They only buy time and transfer pain to the weakest hands. And that's why today matters, not because price dipped. Because the dip revealed the limits of control. They can shove paper. They can't manufacture sustained selling pressure if real buyers are waiting. They can scare people. They can't force a collapse if the bid is starving. They can create chaos. They cannot create supply. Now watch the psychology. After a flush fails, fewer people believe the next flush. That's how manipulation loses power, not in one heroic moment, but in a slow decay of credibility. And a paper market is a confidence game. If enough participants stop believing paper equals metal, the real price shifts to premiums, to delivery times, to whether you can actually source bars. That's where the next battlefield shows up, the spread between what the chart says and what it costs to get physical. Keep one level on your radar, the $80 area. Not because it's mystical, because it's a narrative checkpoint. If price grinds back toward that zone after they failed at $70, the bubble-popped story dies in public. Then the people who sold in fear scramble to re-enter, and volatility flips sides. And when volatility flips sides, it stops feeling like random weather. It starts feeling like a squeeze. Now I want to pull you into the room with 2 direct questions. When you saw that $70, $67 print, what did you feel first? Fear, anger, or calm? And do you think that portal blackout was coincidence? Or a curtain being pulled while the crew fixed something backstage? Drop your take in the comments. Not because we need drama, because we need signals. Our edge isn't a hot take. Our edge is that we think out loud together and thousands of eyes catch what one newsroom can't. We're building a distributed sensor network. People catching outages, delays, premium spikes, strange shipping notices, maintenance messages, odd spreads, live. The mainstream reports after the fact. We see the smoke while the fire is still lighting the room. Now, here's the lens that keeps your head clear when they try to spin you. Fact, paper selling can move price fast. Fact, physical demand can absorb shocks when it's real. Read, the faster the rebound, the shallower the pool likely is on the offer side. Possible risk, they come back again, bigger, uglier, designed to exhaust you into selling just to make the nausea stop. So we do what we always do. We don't panic. We don't chase candles. We watch what actually matters. Dealer premiums, delivery times, exchange behavior, repeated maintenance, shipping friction, and any quiet policy changes that show up as delays. Because those are the fingerprints of a tightening market. And the fingerprints are starting to appear. Now, one more open loop, and then we lean forward. If a key portal can blink in one stress window, what happens in the next one? Do they change reporting rules? Delay updates? Publish adjusted numbers that magically make the ledger look clean? Those aren't price questions. Those are governance questions. And governance shocks hit harder than candles, so keep your eyes open. If you see something weird, An outage, a blocked shipment, a sudden verification required, premiums moving the wrong way? Say it. Post it. Share it. We don't win by yelling. We win by observing. And if you want to stay plugged into these real-time signals with us, subscribe. Short and simple. Subscribe so we catch the next move together. Because after a failed bear trap, the market usually doesn't get calm. It gets violent, and the truly dangerous part? Violence doesn't start when everyone is watching. It starts when they try the next pre-dawn smash, and the rebound happens even faster.